Here's a paradox for you. What happens when one of the best investors on the planet decides not to invest a giant pile of money? You might think he's hesitating, but Warren Buffett? He calls it strategy. Today, we're going to unpack why Berkshire Hathaway is sitting on a record-breaking mountain of cash. And the answer reveals a really powerful strategy that, honestly, any of us can learn from. $344 billion. Just let that sink in for a second. That's how much cash and short-term U.S. Treasury bills Berkshire Hathaway is holding right now. We're not just talking about a lot of money. This is a historic, unprecedented war chest. It's actually the largest ever held by a public company. So, yeah, that leads to the big question, why? Why would a guy famous for buying incredible businesses choose to just hold on to cash instead? Well, here's the thing. This isn't about fear or confusion. It's a super disciplined, totally calculated strategy that we're about to break down. And just to give you a sense of how unusual this is, take a look at this. Right now, about 27% of Berkshire's total assets are in cash. Now, compare that to their 25-year average of just 13%. This is clearly not business as usual. It's a major strategic shift. So, how do we make sense of all this? Well, the entire strategy really boils down to three simple but incredibly powerful words. And it all starts with the first one, price. All right, so the first piece of the puzzle is price discipline. Buffett's rule is pretty straightforward. Only buy wonderful businesses at sensible prices. This has nothing to do with timing the market or predicting some big crash. It's all about having a really high bar and simply refusing to overpay, even for a great company. And if nothing meets that bar, you just wait. And this is a fantastic way to think about it. Imagine you're looking for a house in a crazy, overheated real estate market. You might see 5 amazing homes, but if they're all priced like palaces, the smartest move is to just walk away. Berkshire is doing the exact same thing, just, on a much, much bigger scale. The second principle is patience, but, and this is key, it's an active kind of patience. This huge pile of cash isn't just stuffed under a mattress somewhere. It's parked in short-term U.S. Treasury bills, which are paying a pretty nice return with basically zero risk. So Berkshire is literally getting paid billions of dollars just for being patient. And you've really got to understand the difference here. Getting paid to wait is a world away from just letting cash sit there doing nothing. One is a smart strategy that actually generates income. The other, it's just a guaranteed way to lose money to inflation. It's a holding pattern, not a final stop. And that leads us to the third and maybe the most powerful idea of all, optionality. This cash isn't just a safety net. Think of it as an offensive weapon. When markets freak out and amazing businesses suddenly go on a massive sale, having billions of dollars ready to go within hours is an unbelievable advantage. This analogy is just perfect, right? Being ready with all that cash is like being a firehouse. You've got the trucks, the hoses, the water pressure, all ready to go at a moment's notice. Meanwhile, everyone else is just looking at the sky hoping for rain. When that fire starts, you know exactly who's going to be able to do something about it. And look, you don't have to take our word for it. Here it is, straight from Buffett himself. He knows that things get extraordinarily attractive only once in a while. He's not waiting for a small discount. He's waiting for those rare, perfect moments. He knows that someday the phone is going to ring with a deal he can't pass up, and he'll be very glad he kept his powder dry. All right, so we've got the theory down. Price, patience, and optionality. But what does that playbook actually look like in the real world when you're a company the size of Berkshire Hathaway? Let's dive in. Well, first off, you have to get your head around the fact that Berkshire's size is a double-edged sword. They have to hunt for what they call elephants, not gazelles. Only massive, multi-billion-dollar deals can actually move the needle for them. Then you throw in regulatory hurdles, and suddenly the list of companies they can even consider buying gets very, very short. So where does the money go? It's the same price-first discipline, just applied everywhere. They'll buy back their own stock, sure, but only when it's trading for a lot less than they think it's actually worth. They'll buy stocks of other companies, but only when they're convinced the potential return is way better than what they're earning on their cash. It always comes back to price. Okay, let's bring this all back home. What's the big takeaway for an individual investor? What can we learn from this? And, just as important, what are the potential risks of a strategy like this? You can actually boil this whole thing down to 3 steps that you can use. First, set your standard. Decide what you're willing to buy and at what price, and stick to it. Second, get paid to wait. Keep your dry powder, your extra cash, and something safe that's actually earning you a return. And third, build your optionality. Having that cash gives you the power to be brave when everyone else is being fearful. Now, to be fair, this strategy isn't foolproof. There are real risks. There's something called cash drag, which just means you might lag behind when the stock market is on a crazy hot streak. If interest rates fall, that income you were getting paid to wait starts to shrink, and there's always the risk that a huge pile of cash might tempt future managers to get impatient and make a bad deal. These are all totally valid points. And this brings us to our first big knowledge gap, a real head-scratcher. Buffett always says he doesn't time the market, but his whole strategy depends on waiting for other people to panic. So for you as an investor, how do you know the difference between being disciplined and patient and just being paralyzed by fear? That's a really important question to ask yourself. And that leads to a second, much more practical knowledge gap for you. Berkshire uses US T-bills, but that might not be the right move for everybody. So what are the best, safest options for an individual investor to get paid to wait right now? Is it a high-yield savings account? A money market fund? That's definitely something worth researching for your own situation. So we'll leave you with this one last thought. Buffett is waiting for what the baseball player Ted Williams called a fat pitch, that one perfect opportunity right in his sweet spot. So the real question is, what's your fat pitch? What kind of opportunity would be so good, so perfectly aligned with your standards that you'd be ready to swing for the fences without a moment's hesitation? Figuring that out is maybe the most important step of all.